Pratik Agrawal, Chief Investment Officer with ASK Investment Manager, joins us live. Pratik, fantastic to have you back. Thank you for joining us. Pratik, this week has been a news-heavy yet a volatile week for Indian markets. But if I look at how benchmark indices have moved, benchmark indices are firm like a rock. Nifty yesterday has closed just a shade below 6,550. At a time when earnings are likely to be poor, macro concerns have surfaced up. What explains the underlying strength?
Well, before the start of the result season, we looked at how the markets have behaved, how various stocks have behaved. So frankly, on the day I looked at it, markets were up like 2% over 3 months. So in spite of the volatility, I really believe markets are pricing numbers quite well. If you are looking at 7-8% kind of EPS growth for the year, 1.5 to 2% kind of returns from the market over a quarter is justifiable. So that would be my sense. Markets would tend to be volatile going forward. The news flow is extremely strong and in both directions. I think this is a world which is continuingly being on steroids. It's a funny situation, but most countries, when they print money, people will frown on them. And here we have the whole world practically on its knees telling the US, keep printing, otherwise our markets will fall. And they seem to be obliging, by postponing the end to QE. So news flow, there is fear in the market. At some point in time, the easy money would peak out if it has not already peaked out, and hence it kind of makes sense to be with extremely strong businesses with pricing power. So if you see that part of the market, it's been moving almost in line with the earnings growth that we have seen over past several quarters, and our sense is it would sustain.
Pratik, what's the sense on TCS then? Are we going to see the same kind of moves that we did on Infi or after the earnings?
No, so tech results have been good by and large, slightly better than expectations. One would not really want to comment stock specific, but my sense is look at TCS valuations versus Infosys. Look at TCS ownership versus Infosys before the results. So yes, results have been good, great, but given the ownership, given the valuations, while there may be uptick, we are very, very unlikely to see a repeat of what we saw after Infosys.
So let's say if you have to pick and choose between pharma, FMCG and IT, which sector would you like to endorse?
No, so you spoke of them in the order I will choose them. So maybe it is pharma first, IT second, FMCG third, or maybe pharma first, FMCG second, IT third. But yeah, that would be the 3 key sectors, maybe followed by retail-oriented banks. But both the retail-oriented banks are actually getting pretty pricey. So these would be the 3 top picks. When I say FMCG, it may not mean only the FMCG companies. It may also mean stuff that tier 2 towns and villages consume. Insecticide, pesticide companies are something that we are clued on. Seed companies are something that we are clued on also. FMCG companies which have pricing power. So as of now in the market, every FMCG company is moving up, but not all categories have pricing power. So FMCG companies which have pricing power and are benefiting from low.
Okay, lost him there. Let's look at FMCG once again. Pratik was talking about FMCG stocks. This week it's all about HUL. HUL yesterday started off very well, then retreated in the mid-morning trade and then closed flat. It closed at 688 rupees. But a lot of mid-cap FMCG stocks, because of this Piper effect, are in demand. Britannia closed at 710, 715. Dabur 171. Imami also had a strong session. Colgate had a decent day, and then Godrej Consumer also appreciated very smartly. Pratik, you did mention, you were talking about FMCG sector per se. Now within the FMCG sector, where should one lean? Should one buy into classic defensives like HUL or ITC, or it is now time to really go down the ladder? Look at a Dabur, look at a Marico. It's time to revisit a Colgate, or maybe add in a Britannia.
So I'll give you the broad contours of our thought process. We do not like single product FMCG companies. We like a strong basket of brands. I mean, if you are talking de-risking, then if you have a single product led company, then that adds an element of risk, whatever may be the market share. We like companies with strong brands and pricing power. You may have a strong position in the market, but you may still not have a pricing power. So that is something else to be kept in mind. I think valuations across the board in FMCG leave very little to any kind of accidents. They are really stretched. To some extent, I would want to believe that the monies which have come back from HUL buyback, is going to the same space again. So maybe it makes sense to wait out a bit. And let stocks settle. In vast majority of the FMCG stocks, valuations are peakish.